Why don't they say stop recording option? But anyway, it doesn't matter. Okay, it takes a little while to for that to appear. All right. So we're spending a lot of time on page 13 because actually what Jason Zweig has done on page 13 is really summarize Graham's principles. So that's why, in fact, we are getting a preview of the entire book over here. And that's why we're spending a lot of time. And what I'm doing is I'm using this opportunity here to make sure that you are sort of just refreshing your memory and giving you certain new perspectives on the most important and fundamental ideas in finance, okay? Especially in the corporate finance, where a lot of the jobs are. A lot of the analyst jobs are in the valuation area. So you have to be very clear about your valuation models. So that's what we were doing, and we looked at uh, some of these issues. I'm just writing down a little bit. I added a few, so that's why I need to do this. I can't do this on Create Tricks. I need to do it here because I keep looking at the notes and I think about whether it makes sense for the students. And we try to make it as clear as possible so that I've added, and then I add certain points, right? So we discuss subjective, different answers, and no clear right answer. Objective, all same answer. I've added this, and there's one clear right answer. Okay? So these things we added, and just adding this, the same, all the fair value models have the same basic structure, okay, which I showed you. Forecast of returns and present value technique by discounting it by the appropriate divisor here. Okay, and then you add up the present values. So you basically add up the present values of the future returns. That's your basic formula. And that gives you the fair value. And for each period, obviously, you predict the return and then you discount it accordingly, appropriately. So that's what you should understand and keep in your head. And the general framework which applies to stocks, bonds, that's what I've written here, right? All the stuff that you have already done, you guys have already done all this stuff. Okay? Maybe earnings discount you did not do. That's just a refinement of the dividend discount. Okay? It comes from Robert Schiller, the idea that markets do not discount dividends, but they discount earnings. But it's basically the same idea. So you again have to discount by the cost of equity. So all the stuff you've done, so the same thing. So we've done. And then we already had a discussion on the market as a pendulum. That's where we had the linear versus logarithmic discussion when I was showing you the various charts. And that we have moved to this because it's not really directly connected to the text. So some of your material and your sort of additional links and all are going to be here. All right, so let's come back to this. Now, market is a pendulum, coming to the statement. So that was our first statement from where we just from this statement, as I said, okay, that a stock is not a symbol, not a ticker symbol. It's a business with underlying value that doesn't depend on share price. So from that one statement, there's a lot of ideas contained in that one statement and a lot of perspectives, which you'll see Buffett and Munger repeating in their Berkshire Hathaway AGMs. If you listen, I encourage you to go and listen to the Q&A. Go and search on YouTube. And it's the same. So that's where we got this whole discussion about price versus fair value, subjective versus objective. Very important to understand. And then because all of your work, most of the jobs are going to be in these valuation areas. So you need to understand asset valuation properly. So understand the fundamentals and the assumptions behind each of the models. Okay, and this is what we discussed. Okay, the same basic structure. Right. Now let's look at this other statement that we have. The market is a pendulum. We already discussed that, how the markets goes up and down, right? And we had that long discussion, I think, in the first session itself. Now, what happens here? Now, so there are certain ideas here that you need to be clear about, which is swings between unsustainable optimism and unjustified pessimism. Okay, so what we are talking about here, it makes too expensive. So certain kinds of statements you need to be clear about. Okay, when the market is too expensive, and what is the other term that you have used? Too cheap. Yeah. Okay. So too expensive. When the market is too expensive, the term that many people in the market use is overvalued. Now you would have noticed that today, if you look at let's say if I use the SPY. The SPY is an ETF. An ETF is nothing but a basket of stocks. SPY is Spiders. Spiders is a trademark. Okay. So S&P 500 is the index, and ETF is basically it's a trust. So it's an ETF is just a basket of stocks. So this is actually a ticker that you can trade, and it gives you pretty much the same returns as the S&P 500 index. But you can trade this like a stock. So if you take this, if I give the SPY, now you see how it is. It's been going straight up. Now people are saying that the market. Some of the people that you might know, some people if you talk to, they might say certain things like if you look at the market commentary today, they might say the market is overvalued. They look at the stock index and they say the market is overvalued. Okay, when they feel, what they're essentially trying to say, try to understand the vocabulary and try to understand what is technically incorrect about this, or what is a better way to say this. So what they're saying, this is all connected. Okay, sorry, too expensive. Too expensive means all these things are happening together here, that the market has swung to an unsustainably optimistic perspective. Unsustainable optimism has made stocks too expensive. And typically, when you have a situation like this, people use the expression the market is overvalued. Okay, but what they actually mean is what's meant is what they mean to say is, remember, we have to be very careful about the way we use the word value and the word price. So the market is never overvalued. The market is always dealing in price. Okay, so the market doesn't deal in value. The market always deals in price. But this is how people talk. They talk loosely in the markets. In the industry, people talk in loose terms, and they don't think through analytically. They don't try to be analytically rigorous because people are focused on getting the job done, selling stuff and making money. So they don't have time to think about analytically what is the correct statement, etc. So they use the expression the market is overvalued. What's actually meant is when someone says the market is overvalued, what they actually mean is the market is, okay, let me put this here also. Okay, they say the market is overvalued. It's important for you to understand this. Of course, you're not going to be able to change the way the market talks about it. So the market will continue to say in situations like this, not everybody thinks it's overvalued, but quite a few people do. Okay, you can see them on the, if you listen to the market reports, you can see them. Quite a few people do. So what they're actually saying is, at this point, they will say the market is overvalued. Okay, and so what they actually mean is the market is overpriced. Okay, market is always priced. The market is never valued. Okay, the market only deals in price. The market is overpriced relative to my estimate of. Okay, they don't like my way of putting it. Okay, overpriced here. Overpriced relative to, remember, my estimate. Every estimate of value, there are some exceptions, but generally most of the fair value models that we talk about here, these types of fair value models, these are all subjective. Okay, they are based on uncertain forecasts. You saw the forecast that you made for what's going to be the growth rate. These are all uncertain forecasts. Different people will have different forecasts, and all of the forecasts are uncertain. No one knows who's going to end up being right. That you find out only when after 10 years or something like that. So, therefore, what is meant? So all estimates of value are subjective. Okay, there are some exceptions which I'll just briefly mention a little bit later. Okay, so relative to my estimate of fair value, okay, that's what they're saying. Okay, so some guy who is actually saying, some commentator, market commentator, who comes up and says the market is overvalued. What he's actually saying is at 435, the SPY, okay, it's a proxy for the S&P 500 index. The index is actually, the price of the index is too high relative to my estimate of fair value. Maybe his estimate of fair value is somewhere here. Okay, maybe his estimate of fair value is 300. Okay, maybe he's discounted the earnings of, how do you arrive at this estimate of 301? That is, he just did the same exercise. He predicted the earnings of all the 500 S&P companies, and then he discounted their forward estimates of the earnings by the cost of equity, and then computed the fair value of each of the stocks, and then computed the fair value of the index, which is nothing but an average of all the stocks. It's a value weighted, market cap weighted average. So that's how. So you do that, and then you end up with a value of fair value estimate of 300. So this analyst who is saying the market is overvalued at this point, what he actually means in technical terms, because the market is never valued, the market is always pricing. Okay. So what he actually means is that the market is overpriced relative to my estimate of fair value. Okay, that's, you have to understand that. Okay, this is what is meant when people talk like this. Okay, so too cheap, I'm not mentioning it because it's just the flip side of this. Okay, so I'll just briefly mention it. I'm not writing it. I'll just write and let's see the so that you figure out further. Too expensive, too cheap. What will happen when the market is too cheap? They say the market is undervalued. Like some people are saying, let's say, because let's look at one of the oil majors. These are known as the integrated oil majors. Remember, if you're going to be an equity analyst, you will have to specialize in sectors. One of the sectors is oil and gas. So in oil and gas, you'll have certain types of companies. These are known as the integrated oil majors. These are integrated because they run gas stations or petrol pumps, as we call them here, and they are also digging oil out of the ground. They've got rigs all around the world, and they're just taking the oil out of the ground, they're refining it, and they're distributing it and selling it at the retail centers. That's why they're called the big integrated oil majors. ExxonMobil's one of the most dominant companies in the world historically, but has not been doing too well of late. Lots of pressure on fossil fuels because of all this climate change stuff. Okay, so pressure on the banks not to lend to these fossil fuel companies puts a tremendous amount of upward pressure on the oil price because the supply is going to shrink. They're not investing enough in capex, and so these are all other problems that you have to know. So anyway, so one of the things you could say is ExxonMobil, because there's not much of a like, you could take the view that ExxonMobil is undervalued at this price, because maybe you think that the fair value of ExxonMobil, because you do a prediction of the future earnings of ExxonMobil. Maybe you go here, let's say this is ExxonMobil, and you predict the future earnings, okay, and you think that the oil price is going to stay very high and the demand for fossil fuels is not going to change. Because it's still, we still need so much of fossil fuels to run the global economy. So you say that the demand is not changing, the earnings are going to be very, very high. You discount it by the cost of equity, you come out with a fair value estimate here, which is, let's say, in your case, based on your forecast, let's say 125 or something like that. So let's say even 100. Okay, and now the price is what? The price is 58. So your estimate of fair value is 100 or 105, let's say, and the price is 58. So you will say this: the market has become unjustifiably pessimistic because of whatever reason, maybe fossil fuels being trashed because of climate change, rhetoric, and it has become too cheap. ExxonMobil is too cheap, and ExxonMobil is undervalued. You will now say the market for ExxonMobil stock is undervaluing the stock. Okay, the ExxonMobil market is undervalued. You will say undervalued here. Again, what you mean is the market is underpriced relative to my estimate of fair value, because the market is priced here at 58 and my estimate of fair value is 105. Okay. Is everyone clear about all these things, these statements? Please make sure, if you're not clear, always ask a question, okay? Otherwise, there'll be a problem if you don't understand. These are all basic fundamental ideas which you must be clear about. Okay, so now you've learned one more, a little bit more of, so this is where I'm trying to actually take the elements in the book, but also add certain things that you need to know, which are important, which are connected to these statements in the book. So market is a pendulum swinging between excessive optimism, excessive pessimism, too cheap, too expensive, overvalued and undervalued. That part is not mentioned in the book, but I think it's an important thing for you to be aware of. And again, bringing in the distinction between price and value. The market never deals in value, it only deals in price. So value. So this is actually the wrong statement to make, but this is how people talk in the market, and they're not going to change just because I say so, right? So you'll have to talk in the same way when you go to the market, but you should understand in your head what it actually meant, okay? So that you always keep in your head the distinction between price and value. All right, so we're just going through this. The future value of every statement can be expanded dramatically to include to discuss many important ideas in the fundamental in the domain of fundamentals of finance. Uh, Look at this. The future value of every investment is a function of its present price. Well, actually, the statement is not uh, correct. Uh, what he should have, be very strict. What he should have said is the future return. This actually should have been return, because the value is influenced by market fluctuations and whatever happens here, like the value of this. When you went into ExxonMobil at this point, you didn't know that it would go here and here. Actually, what he's saying is the future return or the future net value. So when we say value, we just mean the closing price, okay? The closing value of the investment. So this is technically not correct. So the return realized on every investment is a function of the present price, or you could make it even more specific, entry price. Okay, so you've got basically three important concepts. So higher the, it's obvious, there's very obvious stuff, of course, but I want to make sure that you guys understand certain return calculations, and I'm going to use this statement again. This is a general statement, so I'm going to take it to the bond markets as well, and I want to make sure that I refresh your memory on certain basics of bond market pricing. Okay, give me a second. Okay. All right. So here we have this statement. So what he really means, understand what he means. Actually, the return that you realize, that's what he said. I'm just paraphrasing him here. The return that you realize is a function of the, not so much the present price, but yes, present price. But what you really mean is the entry price, the price you pay to get into that investment. And the higher the price you pay, the lower the return will be, ceteris paribus, of course. Okay, that is what you learned in economics. Okay, now let's look at the statement. Okay, before that, I'll come back to market rationality. It's actually connected to. Okay, let's finish market rationality. There is this important point, Doctor. You might have done this. I don't know if you did this. EMH, efficient markets hypothesis. Okay, so this is. I mean, it's a kind of a bit of a nebulous theory, but people like to discuss all these things. So I think you should be aware of this. Okay, EMH. Let's call it. Let's write it out. Okay. So the idea is market rationality, or this concept of market rationality. So EMH is an efficient markets hypothesis. It's associated with this guy called Eugene Fama, who might have done some Fama French models as well in your first year. Okay, now this idea here is basically that it deals with the idea of how fast is relevant information I'm writing in a very strict way, actually. In a very general way. How fast is the basic idea is this actually: market rationality and market efficiency. This is really about efficiency, actually. So efficiency and rationality are kind of connected. So let me just come back. Let me talk about market efficiency also, and let me talk about market rationality also. These things you should understand. Let me talk about market efficiency as a slightly different concept. Market efficiency. Save some typing here. So for market efficiency, we go to the efficient markets hypothesis. The idea of market efficiency, which is basically related to this question of how fast is information relevant to determining information. What kind of information? Information that is relevant to determining the fair value of an asset reflected in the price. Sometimes people in the market use the word discounted. This is not in the sense of discount rate, but by discounted, you'll often hear market experts saying, "Oh well, that news about the U.S. debt ceiling that is going to be raised, that's already discounted in the price of bonds." Okay, so what they mean by discounted is not that something like the discount rate, but they mean that it's already reflected in the price of the bonds. Okay? So that's what is meant. Sometimes they use the word discounted. It's already discounted in the price. What they mean is reflected in the price. So how fast? So the question of market efficiency is dealing with the question of how fast is information relevant to determining the. So why are we talking about this? Because we are actually talking about this difference between fair value and these two ideas are connected, because here you make the distinction between price and fair value, and here you show you make another observation that the market actually fluctuates wildly around the fair value, because sometimes it becomes too expensive, overvalued. Sometimes it becomes too cheap, undervalued, so-called. Okay? So these two ideas are actually connected, and what they're actually saying is, okay, so here what they're talking about is implicit in this idea of overvalued and undervalued are these two ideas as well. So you have to understand these are important ideas to understand. So these ideas are actually kind of implicit in this discussion, so we should discuss them explicitly. And what is market efficiency? How far? These are the question of how fast is information, what kind of information relevant to determining the fair value of an asset, reflected or discounted in the price of that asset. Okay. So if it is very fast, we say the market is efficient. Okay. And if it is very slow, we would say basically the market is not efficient or inefficient. Inefficient, okay, or not efficient or whatever. It's actually very slow. Okay, so actually, if you these are not very well-defined theories, because these are all actually, if you really get down to the depth of it, if you really start analyzing these ideas in depth, you'll find that it's all very fluffy, because it's all very subjective. What is meant by reflective? How do I know if something is reflective? So these are actually very deep questions. You don't have to get into that level, because then you'll get actually quite confused, because these are not very well-formulated theories. They're kind of subjective. But these ideas are thrown around in the marketplace. You may actually get asked these questions, like your senior Utsav was asked this question in his interview. He had an interview with ENY, and he managed to clear it. So he's got a job there. Now, but they asked him this question, okay, about the EMH and market efficiency. So it's useful to know of these ideas. Okay, what is it? Basically, what are we talking about? So we say the market is very efficient if the market is able to very quickly reflect the information, new information. Like suppose there's a new discovery. Maybe ExxonMobil discovers a new oil field, okay, of Alaska or something like that. Off the coast of Alaska, they announce a very big discovery of oil. Now, obviously, that's going to add to their earnings. So that should be ceteris paribus, that should be bullish for the share price. So how quickly does that, that new information get reflected in the share price? That's the idea of market efficiency. Okay, so this in the EMH, basically the idea that's being made is you should also do this on your own. You can read up on it. It's kind of a little bit, again, as I said, it's a very, very fluffy kind of hypothesis. Weak form. semi-strong form and strong form. You can read up on your own. Okay. These are three sort of developments. I mean, three sort of subcategories of efficiency that have been discussed. So you can check this for yourself. Okay? Just try to keep it in italics. You can check this for yourself just to know a little bit more about this. But it's actually a very kind of a fluffy theory. The main idea here is that generally markets which are very actively traded, they tend to be quite efficient in the sense that the information that comes out gets reflected in the price. But as I said, if you really drill down deep into these concepts, what do you mean by reflected? So the new oil field that ExxonMobil has discovered, even if we know how many barrels of oil are in there in that field, what do you mean by reflected in the oil price? Suppose that's in the stock price. Suppose the stock price immediately shoots up to 85. Do we really know that? I mean, how do we know that 85 is the fair value of ExxonMobil based on this new information? Because you don't know what the price of oil is going to be. You know how many barrels of oil they have in terms of quantity, but value is a function of price and quantity. So you don't know what the price of oil is going to be 5 years, 6 years, 10 years down the road. So how do you know that 85 is the real price? So these are actually, if you really get into it, these are very problematic concepts. But people have won Nobel Prizes with these theories. But these are actually, if you really dig down into it, they become very, very. You realize that they're basically not very well formulated theories. Unlike stuff in physics and chemistry, those are hard theories. You can really test it, and you can. So these are not really very solid theories, but it's important for you to know these ideas. So the new idea that I introduced to you is, maybe you already did it in your first year, the idea of market efficiency. So it's important to be aware of that. When people talk about efficient markets or inefficient markets, that's what they're talking about. All right. Now, the second idea is the idea of market rationality. Again, not very often spelled out clearly, but it is implicit in this discussion of when you say things like optimism, pessimism. Do you associate rationality with optimism and pessimism, or excessive optimism and excessive pessimism? Would you say that these are the same as rationality? Would you say that a person who's unreasonably optimistic or unreasonably pessimistic, would you say that the person is rational? Yes? Anybody?
Yes, sir. Yes,
You
sir.
would? You would?
Yes, sir,
Okay.
because it is according to his analysis, his or her analysis, that he is doing the work. So, according to me, he is rational, because obviously he won't be investing the money just to, lose it. So there must be some analysis. Maybe he can be right, he can be wrong, but he would be rational only, because rational is like something that if he believes something, so he is, purchasing that share. So I think
Okay,
so.
but
Yes.
no, but the question, no, what you said is correct. What you said is correct. But my question was, when a person is, sort of consumed by unsustainable optimism or consumed by unjustified pessimism, would you say that he is in a rational state of mind?
No, sir.
No,
No,
sir.
Yeah, right.
sir.
Yeah. So
Here,
at this
here
point,
you
yeah,
define here you define that sustainable optimism is present only. मतलब ये पहले से यहाँ पे है. That
yeah, yeah.
उसके बाद वो behavior rational है या नहीं है वो हम.
So, Sanjit, you have to practice speaking in English all the time. That'll polish up your English also, no? Because you can't break into. Because remember, we are practicing here. This is all net practice. You have to be like in your interview. So you can't break into Hindi in your interview. So you have to practice speaking in English all the time. Okay.
Okay.
So yeah. So make sure you keep that pressure on yourself. Okay. Yeah. So So you understand what I'm trying to say. That's why I said this idea of rationality is implicit in this discussion. Okay. You need to understand what is meant by market rationality as well. Okay. So market rationality essentially implies that price. This is the basic idea. Okay. So we'll just develop this when the market is rational. Okay, so excuse my combining all the small, the running hand and the caps. When the market is rational, okay, okay, now everything is all subjective, okay? According to me, price is equal to my, let me copy this, I can copy this. Now you understand what is meant by market rationality. Again, you can see what a loose and inadequate and fluffy feel-good concept this is. Not very specific, not like the concepts in physics and chemistry. When the market, this is important to understand. These ideas are also important to understand in general terms. Like in law, we understand the concept of equity. It's not really something when defined mathematically or in a specific way, like specific gravity in chemistry, which has a very specific meaning, right? But this, equity is kind of hard to define what equity means in the law. But you have a general sense of it, okay? So this is kind of that. These are those types of ideas. Market rationality is important because rationality is the idea of rationality is implicit in this statement that market is unjustified, unsustainably optimistic, unjustifiably pessimistic. These are all intended. These statements are intended as indicating. You're intended to indicate departures from rationality, because when the stock is too expensive, that means it's higher than my estimate of fair value. Okay, if it's here, my estimate of fair value is here, it's too optimistic. So the market is not rational and it is unsustainably optimistic. So these ideas here are connected to the idea of rationality. And what is meant by rationality? The idea that when the market is rational, according to me, everything is according to me. Now, Sanchit may have a different idea. Okay, Mayank may have a different idea. Soumya may have a different idea. But according to me, I say the market is rational when the price is equal to, which is the same for everybody, the price is equal to my estimate of fair value. So don't forget this my business here. Okay, this my and me, this is always to be understood because that's the subjectivity of this concept of fair value. So price is equal to my estimate of fair value. Okay, so when the market is rational. So when this guy is talking like this, what he means is stocks are too high relative to, stock prices are too high relative to his estimate of fair value. Stock prices are too low relative to his estimate of fair value. Okay, as we discussed in the case of ExxonMobil, maybe my fair value estimate is 105, price is 58. So I think the stocks are, the market is not rational. The market is unjustifiably pessimistic. Okay, so this is another important point to be aware of. What is meant by market rationality? There is this loose idea that rationality pertains when price is equal to your estimate of fair value. You say the market is rational. Otherwise, you say the market is either, in the jargon of the markets, overvalued or undervalued. Okay, it's too expensive or too cheap, and otherwise it's rationally priced. The market is rationally priced. So you can see that rationality is also connected to the idea of efficiency, because if you're saying that how fast is information coming, new information comes out about a new oil field that they discovered, and then that quickly rises to 85. So we say the market is efficient because the information about the new quantity of oil has been used by the market to raise the fair value estimate of the stock of ExxonMobil, and then the market has raised its price also to equate to make it equal to the fair value. And that's why we say there is rationality, and we say that rationality was achieved quite quickly, and that is efficiency. That the new information is well, let's make this even more specific and say how fast is newly released information. Okay, generally we talk about this newly released information relevant to determining, reflected in the price of that asset. Okay, because old information is already there. So mainly we are talking about newly released information. But actually, I think we can talk about a little bit, we can put this in brackets. So really, to understand the concept of efficiency, it's useful to see a new release of information and then see how it is reflected. But it also contains the idea of old information and the information in stock prices. Okay, so I'll just briefly tell you about weak form and semi-strong and strong form, because since you might get questions on this. So weak form efficiency means that you can just do your reading, but you can cross-check your readings with my explanations here. You can come back to the video. So weak form, if we say the market is weak form efficient, that means essentially that you cannot make money by analyzing past price history. So the history of all the previous, price was whatever the price history is, all the technical type of information, technical analysis information, that is already reflected in the stock price. So in the asset price, let's talk in general terms. So weak form efficiency means that markets, the history that is there in the past prices, that has already been reflected in the price. So you can't use technical analysis to make money. Okay. So it lose in a very easy for you to remember, to make it very easy for you to remember. Let me write it this way. Okay. We'll write it in a funny way. Okay. If I'm not going to write grammatically correct in English, of course, is so just to quickly summarize this for you so that you know these things, and then you have to do some more reading on your own. You have to revise all this stuff so that you make sure all these things are clear in your head. Okay, let's take this advantage here and write it. If market, of course, if it should be if the market, okay, but I'm not going to go with all these niceties to save time. Okay, if market is weak form efficient, tech analysis, no use. Okay, I'm just writing, of course, broken English to give you the idea. Okay. Then what we'll do is we'll write it like this. Now we'll write it like this. Basically, each of these types of efficiency, if they pertain, they rule out one type of analysis. Okay. So tech is technical analysis. So funda is fundamental analysis. Okay. If market is weak, not weak, this is semi-strong. So then later on, you can go back and revise all this. So there are some important concepts that we have discussed. Again, still related to the idea of price versus value and market prices swinging wildly above and below a particular investor's estimate of fair value. In these two statements and ideas itself, there are many, many ideas that we had to go through. These are very, very important for a fundamental understanding of finance. So before we even come to the third statement. So so we understood the concept of efficiency, the concept of rationality, and there are three shades of the EMH, efficient markets hypothesis. And three shades are weak form efficiency, semi-strong, and strong. So, I haven't put inverted commas here, but that you can do. That you can do eventually. Okay. The market is weak efficient. Technical analysis, no use. Okay. If the market is semi-strong, not a weak form like this. The market is semi-strong form efficient. Fundamental analysis is no use, because what it means is that all the information that comes out of your fundamentals, like I do these financials, I look at the financials of Microsoft. Okay, I try to look at what's in their income statement, in the balance sheet, what's happening to the business dynamics, what's happening with their cloud revenues. Okay, because cloud is expected to grow, continue to grow. Okay, and all this analysis that I do, well, if the market is semi-strong form efficient, it means that all this analysis that I'm doing is a waste of time, because all this information is already reflected in this price. So I can't make any money by doing all this analysis. That's what semi-strong means. Okay. If the market is strong form efficient, Okay, this is what it means. So this is actually semi-strong informed efficiency means all the publicly, well, this is all publicly available information. I don't have any inside info on Microsoft. I don't have you know, I'm not a fly on the wall in Satya Nadella's office listening to the internal discussions about secret, what is happening in the current quarter. I don't have all that inside information, but I have public information, publicly available information, and semi-strong form says publicly available information, no use. It's already reflected in the price. If the market is strong from efficient, it means that even insider trading is no use because even non-public information is reflected in the price. So even the non-public information is reflected in the price. So even trading on inside information is no use. So these are important for you to understand. So please make sure you revise these concepts. Be clear in your head about these concepts. Because as we have seen, one of your seniors has been asked about it in the interviews. So better be clear about all these concepts. And these are things, useful things to know because people talk about these things in the markets. So it's part of the whole discussion about price versus value, overvalued, undervalued. That includes the idea of rationality, and it also includes the idea of market efficiency, where basically once it gets reflected, then it becomes rational. Because then what you're trying to say is that it's just reflecting the estimate, your estimate of fair value. So again, but also don't lose sight of the fact, because generally when people in the market talk about these things, they're not very conscious of the fact of how subjective these fair value estimates are. They're not very conscious of the fact. You'll see, you'll actually see anchors having discussions. Oh, so you really think that this is, is it overvalued? As if, I mean, there are 4 people in the discussion, okay, and each of them probably have a different estimate of fair value. But when the anchor is talking to them, it's as if, they'll be, you can observe all this on for yourself, okay? When the anchor is talking about it, it's as if they all have the same estimate of fair value. It's actually not the case. So people are not conscious of this in the market, but you should be conscious that fair value estimates are all generally all subjective. Okay, I will just put in one exception here. One exception that I should make you aware of. I don't have time to discuss that, but I'm going to put this qualifier here to the statement. So let me put that qualifier in this statement at this part here itself. Let me do this. You don't need to. This example I don't need to give you because I've already given it earlier. Now, what is the statement that I'm making? That this most common fair value models are subjective, okay, commonly used, okay, are subjective because actually they are based on. Let me put this little hedge statement here. Largely because they are based. Some of the subjectivity emanates from the different data sets that are used to calculate beta and things like that, and the cost of equity gets affected. Largely because they're based on uncertain forecasts. That's where the subjectivity comes from. Okay. Right. So this we have already given earlier. Now, these are fair value models. There is a class of fair value models. Okay. Based on how do you understand that? True. Now, where is I put in a statement about arbitrage free valuation. I'm not using it. So this I'm not going to explain right now because it will take a lot of time. But what I'm actually telling you is that, let's say if I say that all nations are island nations, but there are maybe 1 or 2 nations which are not island nations, which I don't have time to discuss right now. So I just make sure that I make that statement so that you're aware that there are a couple of nations which are not island nations. So that later on when you hear them, you don't think that, okay, why did sir tell us about these two nations which are not island nations? But I did tell you about it. But I didn't have time to discuss in detail. But there is a class of fair value models, those based on true arbitrage-free valuation principles. That are not subjective because they are not based on uncertain forecasts. They're based on not based on uncertain forecasts. They are based on tradable prices that are observable, that are currently observable. Okay. So that's basically this. So you have to understand there's a principle of valuation called arbitrage-free valuation. So I'll give you a couple of examples. Okay. Pricing of let's say cross rates in FX is foreign exchange markets, right? FX is cross rates in FX markets. Let me give you some examples so that you can later on you can cross check them when you come across these things. Cross rates in FX markets derived from direct US dollar quotations. So here's an example, one example. Then FX forward rates. We don't have time to do all this, but FX forward rates, these are all examples where you will find that these are not subjective models. These are not subjective fair value models because they're not based on uncertain forecasts. They're based on tradable prices that are observable currently, right now, and you can lock them in right now. So these are not subjective. Okay? These are objective. So this is just a to be correct here, there exists a class of fair value models. So since I've told you mainly, most of the ones that you're going to be using in your work, especially if you're working as an analyst or in valuation, most of the valuation work that you do is related to companies, valuing companies, or valuing maybe a different project or something. All of that is going to be based on uncertain forecasts of cash flows or dividends or earnings or even bond coupons, because sometimes the credit quality is not very good if you're not dealing with high quality sovereign bonds. If you're dealing with the junk bonds, the returns on the junk bonds are not certain. So everything is based on uncertain forecasts. So most of the models that you end up using in finance are actually subjective fair value models. But it's important for you to for me to clarify to you, which I don't have time to go into in detail. But remember in your mind that there is an exception. There is a class of fair value models based on arbitrage-free valuation principles. It's a style of valuation. It's a technique for arriving at fair value. What is arbitrage-free valuation? It's nothing but a particular type of technique for arriving at fair values. It's kind of like, if I take, suppose the iPhone has two parts. Maybe there's or three parts. Maybe there's a case and there's a screen and then there's a processor. I'm just giving a simple example. And if the case is like $5 and the processor is $20, and then so the case is $5, the processor is $20, and the screen is maybe $10. Okay. So here If you put them together, you add some labor cost maybe. Okay, so maybe you add $5 for labor cost to put it together. So if you see an iPhone selling, and this is basically the idea behind arbitrage revaluation. Okay? So if you see an iPhone trading, so you know that okay, this is all there is to an iPhone: casing, the processor, and the screen, plus some labor cost because these are separately available. You go to Chandni Chowk and you buy them separately. But that doesn't make it an iPhone, right? Somebody needs to put it together. So you put in a labor cost for that. So if you have these numbers in your, and you can directly buy all these components, and then you see an iPhone. So what do we get? 30, 35, 30, 40. This is 40, right? So now if you see an iPhone price being quoted in the market, and you can both sell and buy at that price. So somebody is quoting, let's say 75 for iPhones. You can both sell to him at 75, you can buy from him at 75. So now in this case, what will Ayush do? Will he sell at 75 or buy at 75? Yes, Ayush? What will you do? Ayush is sleeping. Okay, let's ask Kapur.
No, sir. No, sir.
What will you do? Yes, Ayush, you got my question?
Can you repeat it?
No, did you see what, did you follow what I was saying here?
Yes, sir. You were asking about whether I will buy it or 70.
So you know, you have all this information, right? And
Yes.
then you see that there's a separate guy in maybe some other market where he's quoting 75 for iPhones. You can either sell to him at 75 or buy from him at 75. For both, the price is the same. So what will you do? Will you sell or will you buy?
Sir, I will sell.
You will sell. And where will you deliver the phone from? Because if you sold to him, then you have to give him a phone, no? Where will you get it from? Yes? Ayush? Any idea?
No, sir.
Okay, Tapur, can you help him? How will Ayush has already decided to sell to this guy at 75? Now, where will, if he enters into a contract, somebody, there's a lot of echo somewhere. Somebody needs to go on mute. Yeah. Yes, Tapur, go ahead.
Sir, I'll buy
Maybe you have the echo. Never mind. Where will you buy?
from
Yes?
place. I'll get it from the lesser price.
Yeah, okay. So we'll assume that there's too much echo there. So what Tapur will do is she will go to Chandni Chowk and buy the components and hire some guy and pay him $5 for the labor. And then she has an iPhone. The cost of putting together an iPhone was $40, and she uses that $40 iPhone to deliver to the guy on behalf of Ayush at 75. He has sold at $75. So together they make a profit of $35. Is this clear? Everyone followed what I've given here, the example?
Yes.
Yes. Okay. All right. Okay. So this is basically what arbitrage revaluation is. So what you do is you are looking at the market price of an iPhone. Somebody is quoting it at 75, and you decide to find out what is the fair value of iPhones. Okay. Now the basic idea I've oversimplified it, of course, but the basic idea behind arbitrage revaluation is this: you try to separately create the same product and see what the cost of creating that product is. So you see here somewhere else, you see the components available for these prices, and you can see putting together the whole iPhone together will cost you only $40. So in this case, what we would say is the fair value. So remember, this is the market price, okay? This is the market price of the iPhone is $75, and this is the fair value. And so what we would say, let me put this here. In this case, what we would say is that the fair value of the iPhone based, or let's put it this way, fair value, let me write it in proper English, derived by applying. So you need to understand how these terms are used in a sentence. Okay. So in this case, what we would say, of course, it's an oversimplified example, but you get the idea. This idea does not change. This is always going to be the idea in arbitrage revaluation. You notice how these are not based on forecasts. These are the prices I can get in Chandni Chowk today for all the components of the iPhone. And here we have some guy who is not plugged into the prices that are prevailing at Chandni Chowk. He does not have good information. And he doesn't know that I can actually, it's possible to put together an iPhone for the cost of $40, and he's quoting 75, and he's willing to both buy and sell at 75. So he's going to have a problem because everybody's going to be selling to him. And essentially what will happen is, let me just finish the statement. A fair value derived by, so that we know how exactly we use these terms. And what is meant by arbitrage free valuation. Now you can also see the difference between okay, so it's not going to come in one because the font size is too big. So let's make it 14. Okay? 14, 12. Right. Okay. So what is this $40? The $40 is the fair value. How do we use arbitrage free valuation in a sentence? We say that in the example that we gave you, let's stay here because it's just one, this is just the market price. Okay. So here we say that $40 is the fair value of the iPhone derived by applying arbitrage free valuation principles. And the principle is here is the valuation technique. What did you do in the technique? You basically asked yourself, okay, here's the price of an iPhone, the market value of market price of an iPhone. In order for me to find out the fair value of the iPhone, let me ask myself, how much will it cost me to replicate the iPhone? And so then I go to Chandni Chowk and I find that I can take the components, I can hire somebody to put it together, and that's all going to cost me only $40. So I say that then of course you have to take the cost of shipping from Chandni Chowk to this market where this guy is quoting this price. Okay, maybe it's in a different market, different location. So you have to factor in the cost of that also, which we did not discuss in the calculating the profit made by Kapoor and Ayush. So we found that it's $35, but you have to of course reduce that by the cost of transporting this product from here to this market, wherever that is. Okay. So, but this what we say is this is the fair value of the iPhone. Let's say ignore that cost for the moment. And then we say this is the fair value of the iPhone derived by applying arbitrage free valuation principles. Now notice, although this is an overly simplistic example, the basic idea remains the same in arbitrage free valuation, wherever you apply the technique. Okay? And notice what's the difference here between, let's say, a Gordon growth model. These are uncertain. Okay? These are uncertain. There is subjectivity in this also, and these are uncertain. These are definitely, this is the biggest problem here. These are uncertain. Here, there's nothing uncertain. These are, that's why I said, you see, they are not subjective models because fair value models based on true arbitrage free valuation principles. They're not subjective because they're not based on uncertain forecast. They're based on tradable prices that are currently observable. So I go to the individual shops which sell these components. I find the laborer. I lock in everything. I say, okay, done. I buy all these things from you. And there I've immediately locked in the cost of my synthetically produced iPhone. So there's nothing uncertain here. There's no doubt about anything. So that's why this fair value estimate is not subjective, it's objective. Is everyone clear about this? What I've explained, connecting the ideas of subjectivity, objectivity, and different classes of fair value models. I've given you a very simplistic example, but at least this idea you understood, right? Please make sure you understand this idea. Everyone clear about this?
Yes,
the difference, yeah, the difference between, yes, Soumya, what is the question?
So I have a doubt.
Yeah.
Since we spoke of market efficiency, do we have any rules for deciding how do we classify something as weak form, semi-strong form, or strong form? And if not, then what is the utility of this hypothesis in the face of all the subjectivity?
No, the rule is basically in the sense, okay, let me try now, let me just, so when we say, first, let's be clear, when we say weak form efficiency, what we are saying is, okay, yeah, so you understood what I meant by weak form. Weak form means that you cannot make money by analyzing the past history of prices. Okay, and then specifically what they say is that prices are, there is no serial correlation in prices, in price series. Okay, so in answer to your question, what do we have any rules? What they typically do is they test for serial correlation in prices. Okay, and then they say that the prices are, there isn't enough serial correlation, it's not statistically significant, etc., etc. Therefore, the prices are, the market is weak form efficient. This is the kind of technique that is followed. But you're right that there is subjectivity there, because actually serial correlation, if you see, if you take a very long data set, you can take serial correlation in many ways. You can take n against n minus 1. Okay, but you can also take n against n minus 2. You can take n against n minus 3. You can take n against n minus 4, n minus 5. And you can do all these serial correlation calculations and going through the whole series. So it's actually very difficult to establish clearly. So there is a certain, as I said, the concept itself is fuzzy. Okay, but this is a Nobel Prize winning theory. This is what happens in economics. So you're right that there is subjectivity, because really, if you drill down to it, it's very hard to prove weak form and semi-strong, etc. All this kind of, because again, you run into the other problem also, which is what exactly do you mean by reflected? You know, they say that the idea is that it's reflected in the price of that asset. At least in the case of weak form, you're talking about something very specific like serial correlation, but that also has problems, because serial correlation between which two prices? Is it n minus n and n minus 1, or n and n minus 2, n minus 3, n minus 4, n minus 5? You can go on and on and on. So there is a lot of subjectivity in terms of all these concepts. But it's important to, the reason I mentioned it, because these things exist, okay? Like, as you can see, your senior was asked about efficient markets hypothesis in his interview. So I want to make sure that you all have a basic sense of what is meant when people talk about these things. Okay, so if somebody asks you what is meant by market efficiency, you are able to talk in some kind of loose way about what is meant by, what is the general idea of market efficiency. Okay, does this make sense, my answer?
Yes, sir. Yes. Thank you.
Yeah. So these are all very warm and fuzzy concepts. They're not very specific, but this is how it works. You have to understand that people are highly subjective. I mean, human beings are very comfortable talking in imprecise terms. Okay? People love to talk like this. You know, if you really drill down to what they're saying, it's going to be you'll find that it's not clear. But then people don't think about all these things. So computers would never put up with the kind of loose, vague, subjective terminology that people use in their human beings use in their conversations. If you ask a computer to evaluate those conversations, the computer will not be satisfied, because computers want things to be very highly specific. So that's the idea here. Okay, so you still have to have a sense of these concepts. So understand in general what is meant. That's what you have to do. That your duty as a student here is to understand, because these are things that people discuss in the markets. So therefore, you should have a general sense of what is being meant when these statements are when these words are being thrown around. Okay, the market is irrational. Like, for instance, here, when I talked about market rationality, there's actually a book by Robert Shiller called Irrational Exuberance. Okay, so this is optimism. Exuberance is optimism. So he's talked about excessively high prices for stocks, and he's used the term irrational exuberance. So there you can see the word rationality. It's irrational because it's exuberant, optimistic. If it were not, optimistic, or either optimistic or pessimistic, if it was just fairly valued and the price was equal to fair value, that would be rational. It would not be irrational. So that's the context here. Okay. Right. So if we go back to this now, these are some important concepts to discuss. Yeah. Rates now. So I just wanted to make sure that you understand. I don't have time to go into more detail on arbitrage-free valuation, but I've given you the basic flavor of arbitrage-free. All arbitrage-free valuation might use some very fancy mathematics, but the basic idea of what they're doing is they're trying to replicate. They're looking at a market price for something, and they're trying to replicate that exact same asset by looking at some other component prices and putting them together to create that same asset in a synthetic way. and that's how you get, and then whatever the value of whatever the cost of putting together the synthetic equivalent is, that's the fair value. Okay? So yeah, so that's okay. Now I think there's one more thing. Let's see where we are. This thing runs to 2:30. Okay, let me just quickly. We don't have that much time. Market is overvalued, undervalued. Remember, you have to do this vice versa, undervalued part yourself. Okay. Market rationality, market efficiency. There's something else in here which I want you to understand and be very explicit about. Okay, we'll go into these entry price spots later. Okay, let me put it here. Let's put it here. Okay, let's put this here. Let me call this the price, since we have already had a fair discussion about price and fair value. Let's understand and be very clear about the paradigm. In 7 minutes, I should be able to quickly explain to you, and we can also make it. This is very important to understand, because then you can apply it in this. The examples that we are discussing now, they may seem very obvious, but if you don't have the general paradigm very clearly etched in your mind, you will not be able to apply it in other situations. What are we talking about? The price versus fair value paradigm. Okay, it's a big word, paradigm. I didn't know it when I went to Ahmedabad 1988. So our professor in one of our first classes used the word paradigm. So I was blown away. What is paradigm? When he explained to me that paradigm is basically a worldview. Okay, it's a way of looking at it. Okay, so you can say capitalist paradigm or socialist paradigm or this, that. So it's a way of looking at the world. Okay, it's a worldview. So what is this? Oh, it's a kind of a framework. You can think of it as a framework. So what is this framework here? You have to understand. Right. Now let's ask somebody here quickly. Right. Okay. All right. So going back to my example, okay, I do an analysis, and based on my fair value analysis, we have based on my fair value analysis, we have let's say the fair value is 105 of ExxonMobil. Okay, do the forward projections of their earnings and etc. All that, and I come up with a fair value estimate for ExxonMobil at 105, and the market price is 58. So now, what should I do? What is my course of action? Should I buy ExxonMobil or should I sell it?
So buy.
I should buy it. Who was that?
Buy.
Mayank.
So
Okay.
Piyush.
Now, yeah. Okay, Piyush. Okay. So, why should you buy it? Why should I buy it? Yes,
Sir,
Piyush?
because my fair value analysis is 105, but the
Yeah.
stock is valued at 58.
Yeah.
So if according to my analysis, the value should go up in the coming future. So if I buy at a lower price and then sell it later at the higher price, then I will profit from it.
Okay, good. So what Piyush has clarified, okay, there's an implicit belief that price will eventually. Why did Piyush say I should buy? Because he also, like me, shares this belief. There's an implicit belief here, okay, that which I forced him to make explicit, that price will eventually rise towards fair value, or my estimate of fair value. Okay, so that you have to understand the underlying assumption or the implicit belief that in this, when you're using this price versus fair value paradigm, why is it price versus? Because what we are doing is we are looking at the price, which is very easy to see. Just pull up a charting software and pull up any kind of charting spreadsheet, any charting software. You can see the price, or even look at Yahoo Finance, you can see the price. Very easy. Fair value takes more time to calculate, but you calculate your fair value. So that's why it's price versus fair value, because you're comparing these two. Okay, and then when you see that the price is below the fair value, now Piyush tells you to buy. Why? Because this paradigm includes an implicit belief that price will eventually move towards fair value. Okay, this is what is important to understand, that price will eventually move towards fair value. This is what we believe. Okay, This is very important to understand. So whenever you're using, similarly, when I do this analysis, let's say, look at Netflix, and I say, wow, this is too high. This company is, with the market, we say, overvalued, 512. The fair value of this stock is 200. So what should I do now? I should buy or sell Netflix? Anybody?
Well,
Yeah, I should sell Netflix because there's the paradigm that I'm using, price versus fair value. The implicit belief is that price will eventually move towards fair value. So I will sell Netflix. Okay, so please understand this. But of course, there's no guarantee that such a thing will happen. Price can keep on going towards 200. Like there were people who were selling Tesla, and they got taken to the cleaners. Okay, so you have to understand that there is no guarantee. There were people who were selling Tesla at this level, 43, and they got taken out. All short sellers, many short sellers got taken out. So there is no guarantee that what you believe will happen will actually happen. All right. So that's why you see the latest statement that he makes. No investor can ever eliminate the risk of being wrong. All right. So this is important to understand that whenever you're applying this paradigm, so if the price is below fair value, you will buy. Maybe take, yeah, I'll just explicitly write it down. Okay. So the rule, what is the decision rule? What is the rule that comes out of this? It's kind of obvious, but I want to make sure that you understand it clearly. If price less than fair value, then buy. If price greater than fair value, sell. Okay. This now again seems very obvious. Why am I writing these kind of things? Because you will need this framework in other situations also, where the conclusion may not be so obvious. Okay. So in this thing, this is the basic important thing to understand. This is the price versus fair value paradigm. You compare the two, and then if this is the rule that you follow. Okay. This is what I wanted to emphasize here. Yeah. Now I don't want to take up more of your time. I've already taken 55 seconds extra. Okay. So your class is dismissed. So we'll continue with this. Okay. Don't get disappointed that we are moving so slowly, because here this is a summary of the whole book pretty much. We're covering important concepts. Okay. So your class is dismissed. You can leave, and those who have questions can stay back. Please make sure you finish this, folks. Everybody's name should be there. Okay. Whoever's left out later on, I will allocate. Only 3 or 4 members. Okay. Please make sure you finish this. Write your names properly. Somebody's name I saw, Kirit, with small letters. Write it nicely, because later on when I give your grades also, Kirit K. Okay. Write your name properly, because when I give out your grades also, this is going to be in your grade sheet. All your grades when I give you the PGDM office, because the group project scores will be the same for everybody. So I'm going to give the sequence here. I'm just going to hopefully have to take Sanjit Jain is not careful enough about his surname, and he has put it in small j. All these, please take care. Be careful about just be a perfectionist in all these matters. Okay. All right. So please finish this. And anybody has any questions, we can take questions now. The rest of you can leave, of course. Yeah.
Thank you, sir.
Yeah. Any questions? Okay. Nothing. Okay. So we'll end it here. Please revise, folks. Please revise everything that is being taught. Lots of conceptual material is being taught. If you don't revise it multiple times, you will not be clear. Okay, you have to take, that's why the video is being provided. I'm writing the notes and I'm editing the notes later on. I look at it, whether it makes sense for the students. I try to edit and add stuff. All this is being done so that you can jam it into your brain permanently. And that will only happen if you do revision all the time. Make sure you're clear about the concepts. If you're not, you ask me. I will set up. There is no limit on tutorial sessions. Okay, we will conduct as many as you need. You ask me for clarifications if you need them. But your duty is to make sure that you understand these things conceptually. Don't memorize anything. There's nothing to memorize here. Okay, you understand everything conceptually and logically. That is your responsibility. If you fool yourself and you have not understood, and you don't ask questions, then you're the one who's losing out. I'm not losing out. Okay. So please make sure you do your duty as a student. Your duty is only to listen and ask questions when you're not clear. Okay. All right. Okay. So I'll end it here now. I'm going to end the recording. Stop recording. Stop recording.